October 1929. Picture yourself standing behind a counter in Youngstown, Ohio. Your name is Robert. You're 34 years old. You earn $2,400 a year, slightly above the national average. Your wife Margaret teaches Sunday school at First Presbyterian and keeps a small vegetable garden behind the house. You have two boys, ages 7 and 5. You bought your home in 1926 with a $1,200 down payment and a mortgage from the very bank where you work. Your savings account holds $3,200, not in stocks. You have never bought a single share. Only about 2.5% of Americans own equities at this point in history. What you have is cash in a savings account at the bank where you clock in every morning, hand money across a counter, and watch the vault doors close at the end of the day. You can see the vault. You know the money is there. The Dow Jones Industrial Average closed at 381 on September 3rd. Economist Irving Fisher has just declared that stock prices have reached what he called a permanently high plateau. But you don't follow the market. You follow your savings account balance, $3,200. Now watch what happens next. Black Thursday, October 2, 19 to 9, nearly 13 million shares trade in a single session, double the previous record. The ticker tape falls so far behind that traders cannot determine what stocks are worth in real time. Panic selling erupts before noon. A consortium of bankers led by Thomas Lamont of J.P. Morgan stages a rescue operation. Richard Whitney, vice president of the New York Stock Exchange, strides onto the trading floor and bids $205 per share for 25,000 shares of U.S. Steel, well above the market price. The selling pauses. The market closes down only 6 points. The newspapers call it a correction. Robert reads about it the next morning over breakfast. Margaret asks if they should worry. Robert says no. They don't own stocks. Their money is in the bank. Black Monday, October 28th. The Dow drops nearly 13% in a single day. No consortium appears. Black Tuesday, October 29th, 16.4 million shares trade. The ticker tape doesn't stop printing until 7:08 in the evening, more than 4 hours after the closing bell, recording roughly 2,500 pages of transactions. $14 billion in market value disappears in a single day. The New York Times describes hysterical crowds and faces white with terror on the exchange floor. Robert does not own a single share. He watches the headlines from behind his counter in Youngstown. His savings account still reads $3,200.193. The banking cascade begins. Stock crash does not immediately destroy ordinary Americans. What destroys them is what comes next. In 1930, more than 1,300 banks fail across the country. The most catastrophic is the Bank of United States, which collapses on December 11th. It holds over $268 million in deposits from more than 440,000 account holders, most of them Jewish immigrants in New York City. Most with accounts under $400. On December 10th, a small businessman visits his Bronx branch. The manager denies his loan extension. He says something to people standing outside. A crowd gathers. By the following morning, over 20,000 people are standing in front of a single branch. Mounted police turn them away. There is no deposit insurance. If your bank fails, your money is gone. Robert sees the news of the Bank of United States failure. Then he looks at the books at his own bank. He sees the loans, mortgage holders who lost their jobs, businesses that shuttered, borrowers who have simply stopped repaying. He says nothing to Margaret. 1931 minus 2,300 more banks fail. In Youngstown, the steel mills are cutting shifts. A local attorney named Benjamin Roth keeps a diary. On August 22nd he writes, "There is a quiet but steady stream of depositors at every bank in Youngstown this morning, withdrawing their funds without a word." On September 1st, Roth writes, "It has become popular to wear old clothes, to brag about poverty and how much you lost in the crash. It is almost bad taste to give a big party or to drive a new car." And then, on September 4th, he writes the single sentence that captures the entire depression: "Banks are absolutely terrible in their insistence on payments on notes and mortgages. It is the old story of lending you an umbrella when the sun is shining and then demanding it back when it rains." Robert watches the withdrawals from behind the counter. He can see the vault getting lighter. He knows how banking works. The bank has lent out most of its deposits. If enough people withdraw simultaneously, there won't be enough left. He considers withdrawing his own savings. He doesn't. It would feel like a betrayal. He is an employee. He is supposed to believe. March 1932, the doors close. Robert arrives at 7 o'clock in the morning, as he always does. The branch manager is waiting in the lobby. The state controller has declared the bank insolvent. The doors will not open today. Depositors will be notified by mail. Robert's $3,200 is inside the building. He is standing in the lobby. The money might as well be on the moon. In the months that follow, receivers liquidate the bank's assets. Depositors receive partial payments, cents on the dollar. Bank passbooks trade on secondary markets at 30 cents on the dollar. Prices quoted in daily newspapers alongside livestock. Some depositors recover 40 cents. Some recover nothing. Margaret finds out when Robert comes home at 8:30 in the morning instead of 5:30 in the evening. He is still wearing his coat and hat. By the end of 1932, unemployment reaches 23.6%. Average family income has fallen 40% from 1929. Landlords evict 273,000 families in a single year. 9 million savings accounts vanish to million. Americans are homeless. The Dow bottoms at 41 on July 8, an 89% decline from its 1929 peak. It will not return to that level until November of 1954, 25 years, March 60th, 1933 to 1 o'clock. And President Franklin Roosevelt, inaugurated just 2 days earlier, issues Proclamation 2039. Every bank in the United States is ordered closed. The bank holiday. For 1 week, no American can withdraw a single dollar from any bank in the country. No checks clear. No wire transfers move. The economy runs entirely on whatever cash people have in their pockets. Margaret has $11 in her purse. Robert has $4. On March 12th, Roosevelt delivers his first fireside chat on the radio. He tells the nation it is safer to keep your money in a reopened bank than under the mattress. He calls hoarding currency unfashionable. Banks begin reopening on March 13th, but not all of them. Of the roughly 18,000 banks that existed before the holiday, about 12,700 reopen. Close to 4,000 never do. Here is the detail that stops most people cold. When the banks reopen, depositors line up, not to withdraw, but to deposit. Americans bring back the cash they had been hoarding. Within 2 weeks, they redeposit more than half of all currency withdrawn during the panic. On March 15th, the Dow surges 15%, the largest single-day gain in its history to that point. Roosevelt's fireside chat worked. He saved the banking system. But for the 9 million Americans whose banks had already failed, including Robert, there is nothing left to redeposit. What saved Robert and Margaret? Not the government, not the market. 5 things that the banking system could not touch. First, Margaret's garden. The vegetable plot she had tended since 1927 as a hobby became the family's primary food source. She expanded it to cover the entire backyard: potatoes, tomatoes, green beans, carrots. She canned everything she couldn't eat immediately. 37 jars of tomatoes in the summer of 1932, she wrote to her sister. The boys helped weed. Rural families across the country did the same. Farm families who raised their own dairy, their own chickens, who bought flour and sugar in 50-pound sacks, who sewed clothing from feed sacks. Even with zero cash income, they survived. Urban families with no productive capacity faced destitution. Second, Robert's skills. After losing his bank job, Robert found work as a bookkeeper for a grocery store at half his former salary. His ability to manage accounts, handle cash, and maintain ledgers was transferable. Benjamin Roth noted in his diary that the Depression rewarded people who could do something useful with their hands or their minds. Doctors, nurses, carpenters, people who could slaughter an animal, preserve meat, or repair a motor had income when currency itself became scarce. Third, their church. First Presbyterian ran a soup kitchen from November 1931. Margaret volunteered 3 days a week. The arrangement was unspoken but understood. The volunteers' families ate first. Before the Depression, roughly 1/3 of all adult American males belonged to fraternal organizations: the Masons, the Elks, the Loyal Order of Moose. These groups provided sickness and burial benefits, ran hospitals and orphanages, operated job exchanges. These networks were the only safety net that existed before the New Deal. Fourth, they owned their home. They had a mortgage, and the payments were brutal on a reduced income. But they were not renters. They could not be evicted on a landlord's whim. They negotiated with the bank holding the mortgage, a different bank from the one that had failed, and received a 6-month forbearance. Many homeowners eventually lost their properties to foreclosure. Many renters lost their homes immediately, but homeowners had leverage that renters did not. The bank didn't want to own the house any more than the family wanted to lose it. Fifth, they did not panic. Benjamin Roth's most enduring observation fits Robert and Margaret precisely. This depression has impressed on my mind one thing: the value of having on hand sufficient capital to cover emergencies, patience to wait for the right moment, courage to buy or sell when that time arrives, and liquid capital. These are the three essentials. Robert and Margaret had lost their savings. They had not lost their house, their garden, their skills, their church, or each other. By 1934, Robert held a full-time position at a manufacturing firm's accounting department. Margaret's garden had become a model for the neighborhood, for other families on their street had started their own. By 1935, life was tight, but functional. The Depression did not end in 1933. It did not truly end until the war. But the worst of it, the bank failures, the mass unemployment, the starvation, passed through like a wave. The people still standing when the wave receded were the ones who had something the banking system could not take. What this means right now: Congress created the FDIC in 1933 specifically to ensure what happened to Robert could never happen again. For 90 years, it worked. No insured depositor has lost a penny since the FDIC began operations. But the guarantee has a ceiling: $250,000 per depositor per bank. Everything above that line carries no federal protection. In March 2023, Silicon Valley Bank failed with over $150 billion in deposits, the majority of them above the FDIC limit. The government stepped in with an emergency guarantee. Robert's bank failed because its borrowers stopped repaying loans. Silicon Valley Bank failed because it held long-duration bonds that lost value as interest rates rose. The mechanism was different. The gap between book value and real value was the same. Ask yourself, is there a category of loans sitting on American bank balance sheets right now that might be worth less than the books suggest? Commercial real estate is at the top of that list. Office vacancy rates in major American cities have not returned to pre-pandemic levels. Regional banks hold a disproportionate share of these loans. The Federal Reserve has provided emergency lending facilities to prevent a cascade. Those facilities are temporary. Robert did not lose his money because his bank was criminal. He lost it because the system designed to protect depositors did not yet exist. Today that system exists, but it has limits, and no one has tested those limits at scale since 1933. Benjamin Roth wrote it from Youngstown in 1931. It still describes the difference between the family that comes through and the family that doesn't. The value of having on hand sufficient capital to cover emergencies. Not capital in a bank. Capital in your hands.